There is a legal federal tax rate of 0% on capital gains, and most people at the $2 to $5 million level qualify for it, but don't take advantage of it. Not because they're in a low income tax situation, because retirement creates a specific window, the years between when your salary stops and when required minimum distributions begin, where your taxable income drops low enough to hit the 0% threshold for the first time since you started working. A $300,000 appreciated position harvested over time inside of that window can mean $0 in federal capital gains tax. The same $300,000 position harvested 1 year too late or too much at once can trigger thousands of dollars of unnecessary taxes. I've seen this happen. A prospective client sold $90,000 of appreciated stock in January planning to pay no taxes. His first RMD arrived in March. It was $110,000. By April, his taxable income for the year was $200,000. The 0% rate was gone on every gain he'd recognized. The window had opened, but nobody was watching, and it closed in a single month. If you have appreciated positions in a taxable account and you're 10 years to retirement, this video is specifically for you. I'm Ryan Knoll, founder of Nav Wealth, a firm that helps people nationwide near retirement make smart money decisions. Today I'm going to show you exactly what the 0% window is, the two things that close it before most people use it, and how to know whether it's available in your specific situation before you sell anything. I'm going to cover two pitfalls you need to avoid and two strategies that will help your chances of success. And be sure to stay until the end where I go over a case study that will tie this all together. The federal capital gains tax has three rates: 0%, 15%, and 20%. Which rate you pay depends entirely on your taxable income for the year, not on how much the asset appreciated, not on how long you held it, not on your account type. The 0% rate applies to long-term capital gains for married filers with taxable income below $98,900 in 2026. And for single filers, that number is half, $49,450. Below those thresholds, every dollar of long-term capital gains stock appreciation, mutual fund distributions, appreciated real estate is taxed at 0% federally. If you're earning a W-2, you don't qualify, period. This window only affects people whose paychecks have stopped. But for someone who is retired, has no salary, and RMDs not yet begun, taxable income in those years can be low enough to bring the 0% rate within reach. The same investor who paid 15% or 20% on capital gains during their working years may qualify for 0% in the years between retirement and when the required distributions start. This is not a loophole. It's the tax code working exactly as designed, rewarding lower income years with preferential rates. The problem is that most people in the $2 to $5 million range don't realize their income is low enough to qualify, or they make an income decision that pushes them above the threshold without knowing it. Miss one is something most advisors gloss over. Most advisors will tell you to do Roth conversions. They will also tell you to harvest capital gains in the 0% tax bracket. But what they don't tell you is that these strategies both compete for the same space, and choosing the wrong strategy can cost you thousands more in taxes over your retirement. Both strategies require low taxable income to work. When you prioritize Roth conversions, which typically requires filling the 22% bracket each year, your taxable income is typically $150,000 to $200,000. That is well above the $98,900 threshold for the 0% capital gains rate. You cannot fully execute both strategies in the same year. The income from one crowds out the other. Most people default to Roth conversions, which is often the right call, but they do so without realizing they've closed the 0% gains window entirely. The planning question is which strategy produces more lifetime value in your specific situation. For someone with a large taxable brokerage account full of appreciated positions, the 0% harvesting window may be worth more than additional Roth conversions in a given year. That calculation requires running the numbers, not defaulting to just one strategy. The second miss is a single income event which eliminates the window for the year. A required minimum distribution, a Social Security payment that starts mid-year, a dividend distribution from a mutual fund in December. Any one of these can push taxable income above $98,900 and eliminate the 0% rate for the entire year. and this is where thousands of dollars are lost to taxes. Capital gains rates are determined by total taxable income for the entire calendar year. A gain harvested in January counts the same as a gain recognized in December if you're over the taxable income limits. A prospective client, a married couple, sold appreciated stock realizing $100,000 in gains in January of the year in which they turned 70. Their taxable income after deductions was roughly $70,000 from the gains they realized. At that point, they were still in the 0% bracket, but what they forgot is that they also started taking Social Security. He and his wife combined benefits were $80,000, and this added $68,000 to their taxable income bucket. At this point, their gross income for the year was $100,000 from the gains realized and $68,000 from the taxable portion of their Social Security. After they take their standard deduction, they have taxable income of $135,800. The money is taxed as follows: $35,800 on the ordinary income schedule, which is the taxable Social Security benefits less the standard deduction, and they would pay roughly $3,800 in ordinary income tax on that money. And then their gains, which were $36,700, are taxable. To find that, start with the 0% bracket threshold of $98,900. Subtract from that the $35,800 from their ordinary income, which leaves them with $61,300 worth of room within the 0% bracket. But they realized $100,000 worth of gains, so they're taxed on the overage of $36,700, which is roughly $5,500 worth of tax. So their total tax bill was $9,300. Roughly 60% of this bill was avoidable had they only realized gains up to the 0% threshold. Making that same mistake annually can easily cost these investors over 6 figures in taxes after accounting for portfolio growth over their retirement. The couple did everything right individually. They sold appreciated stock and planned ahead. What they didn't do, and what their CPA missed, was modeling the full year income picture proactively. They only looked back at what happened in the prior year. They have done this same song and dance since he retired at age 65. Never looking ahead, but always looking back, and it finally caught up to them. Before we jump into what the retiree could have done differently, I wanted to take time to thank you for watching our video today. We specialize in helping retirees with $2 to $10 million keep more of their hard-earned dollars through tax-efficient planning and investing. If this is you, throw this video a like and subscribe to the channel. We drop content like this every week to educate and empower you. And for those of you who might need more one-on-one guidance and have $2 million in taxable brokerage accounts or more, and you're inside 10 years of retirement, the planning window I'm describing has a real expiration date. Book a call. We'll tell you exactly in 30 minutes whether your window is open, when it closes, and whether we're the right firm to help you use it. The link is in the description below. Now, before we jump into what this investor could have done differently, I want to go over 2 strategies they could have used well before their RMDs and even retirement started to help absorb more unnecessary taxes. I will go over 2 pitfalls to look out for with each strategy to make sure that you're not delaying an even bigger tax bomb down the line. The first strategy is capital gains harvesting. Let's say a retired couple can sufficiently fund their lifestyle and realize only $70,000 of taxable income from gains to do so. The upper limit for the 0% bracket is $98,900. This means they have room to realize another $28,900 worth of capital gains completely tax-free. So what they should do is realize those gains and then reallocate the proceeds back into their portfolio. This raises their basis and decreases their future tax burden. They also do not have to worry about the wash sale here because these are capital gains, not capital losses. So if they sold Amazon stock, for instance, at a gain to reset their basis, they could buy it again immediately if they wanted to. There's no tax ramification and future tax savings are unlocked. The pitfall here is not understanding the difference between adjusted gross income and taxable income. This leads to the wrong amount of income being realized and either realizing too little or too many gains and not the optimal number. Just know that the adjusted gross income is all of your income sources added together. Taxable income, on the other hand, is your adjusted gross income less your standard or itemized deduction. Know the difference and save the taxes. Strategy 2 is focusing on your portfolio structure. One of the biggest mistakes you can make is in your taxable brokerage accounts. Dividends, interest, and capital gains distributions all affect your taxable income and ultimately how many gains you can realize. In your brokerage account, try to limit dividend-paying stocks and funds. Take note of how much interest you earn on your cash and be sure to add that into your adjusted gross income. Avoid mutual funds that kick off capital gains distributions and use municipal bonds which pay tax-free coupons. Doing all of those will help you to make sure you stay within your limits. The pitfall here is tailoring your portfolio so much to stay within the 0% range that you're giving up returns. It's important to keep your taxes low, but not at the cost of giving up hundreds of thousands of dollars of compounding investment returns over time. One bonus strategy to think about is comparing capital gains harvesting to Roth conversions. These two strategies compete for the 0% bracket dollars, so knowing which to use and when to use them is important. If your future tax rates, once your required distributions start, are tracking to be higher, Roth conversions typically make more sense. If future tax rates aren't materially higher, compared to the two scenarios with the full capital gains harvesting versus a hybrid approach where you do smaller Roth conversions within your current bracket and harvest gains around them, whichever produces the lower lifetime tax bill wins. And run this analysis every year. The right answer can change annually as your situation evolves. Now on to the case study. Joe and Sally just retired. They have $3 million saved. Exactly half of their money was in a traditional IRA, and the other half was in a brokerage account which has $500,000 worth of unrealized gains. They are currently 62 years old and need $10,000 a month to live on. They have not taken Social Security yet, and at full retirement age, their expected benefits are roughly $60,000 annually. Here's what they should think about. Their capital gains can be very efficiently harvested early on in their retirement years. If they need $120,000 to live on and roughly 1/3 of their portfolio is gains, they only have to realize $40,000 worth of gains to meet their spending needs. And just to clarify, this is gains within their brokerage account only. After accounting for their standard deduction, this $40,000 worth of gains only counts as $7,800 worth of taxable income, meaning they still have roughly $91,000 worth of room to work inside the 0% bracket. They can effectively realize most of their capital gains around full retirement age of 67, completely tax-free. Their IRAs have grown in the background to around $2 million at that point. They now have 3 years before they have to take Social Security to spend from their IRAs. They take the $120,000 a year to spend, and that same amount is converted to Roth dollars. That's $240,000 of gross income, and after the deductions are factored in, taxable income is around $207,800, giving them roughly $4,000 worth of gains to realize to stay within the $211,400 22% tax bracket. Taxes are paid from the brokerage account to keep as much in the Roth as possible. Since they realize most of their gains already, this is doable. But if not, they'll want to reduce their conversion amount to make the math work. Over the next 3 years, their IRA is worth roughly $1.6 million, their brokerage account is worth roughly $2 million, and they have a Roth which has now grown to around $400,000. They turn on their Social Security at 70, which pays them around $75,000 annually after step-ups. And they continue to supplement their income from the IRA and perform conversions with the amount left over up to the 22% bracket limit, all while paying taxes out of their brokerage account. RMDs will start at 75, but they are spending that portion of their funds to supplement Social Security. So they continue to fill up the 22% bracket with conversions to get as much into their Roths as possible. Their tax picture does not change much until around age 85 when they've spent down their IRAs and now everything is in their brokerage account and Roth accounts. The next move is to go back to capital gains harvesting to meet their spending needs and fill out the tax bracket before tapping the Roth once that runs out. But the important thing here is they no longer have to worry about federal tax liability. Based on work with past clients, I would quantify this at around $300,000 in taxes saved over retirement. Compounding that out at a 6% annual rate of return, that's close to $500,000 in lifetime value added. The 0% capital gains window opens in the years between retirement and required distributions for most people at this asset level. It closes the moment income crosses the threshold, from RMDs, from Social Security, from Roth conversions, sometimes from a single mutual fund distribution you didn't even see coming. For a $300,000 appreciated position, the difference between harvesting inside the window and outside is $45,000. For a larger position, that's even bigger. If you have appreciated positions in a taxable account and you're within 10 years of retirement, that conversation is worth having before the window opens, not after it's closed. There's a link in the description to get on our calendar. If you're not ready for that yet, subscribe to the channel to get weekly updates and use some of our tools linked in the description to get working on your 0% model. I'll see you in the next video.